A single crisp $1 bill floats in midair, suspended against a pitch-black background, spinning slowly as if caught in gravity's absence. We see the fine lines, the Liberty's eyes, the intricate engraving. Then, without warning, the bill trembles, edges curl, the green fades to dull gray. A faint sizzle cracks in the silence. Smoke curls upward as the note disintegrates. The last thing we see is the torn portrait of George Washington dissolving into ash. Money is trust. In the United States, currency is more than paper. It's a pact between citizens and their government. But when the rules that underpin that trust are rewritten, when policies shift beneath our feet, the pact can crack. In 2025, Washington moved decisively, and what happened next landed in the most personal place possible, your wallet. Cut to sweeping aerials of Washington, D.C. The Capitol Rotunda glows at dawn. The U.S. Treasury building stands stone-faced. The Federal Reserve's towering facade looms. The hum of urgency fills the air. A new era of fiscal architecture dawned, one that reshaped taxes, trade, and borrowing more radically than anything seen in decades. For better or worse, it re-engineers how the federal government raises money and how that cost is passed on. This isn't just about policy, it's about power and who pays. To understand the magnitude of the 2025 policy shift, we must first trace its roots. In 2017, the Tax Cuts and Jobs Act, TCJA, dramatically lowered income tax rates across nearly all brackets. The promise was simple: stimulate growth, reward investment, and let Americans keep more of their earnings. But beneath the celebration, a structural truth lurked. The tax cuts, while politically popular, were set on a collision course with the federal budget. By the time the sunset clauses on many TCJA provisions approached, a debate ignited. Renew them, let them expire, or rework the tax code. Rather than expire, Congress in 2025 made a daring choice. They made many cuts permanent. In parallel, for decades, the United States had wrestled with its debt ceiling, a self-imposed limit on how much the Treasury could borrow. Historically, this raised tension, but by 2025, the stakes had escalated. In a watershed move, lawmakers agreed to raise the debt ceiling by $5 trillion, locking in a permissive borrowing regime for the foreseeable future. This was not an accidental collision of fiscal levers. It was a deliberate realignment. Washington redefined its long-term borrowing capacity, secured permanent tax policy, and laid the foundation for sweeping trade measures. What had once been separate levers, taxation, trade, debt, were now intentionally intertwined. On April 2, 2025, the White House invoked its new reciprocal tariff policy, a centerpiece of its revitalized trade doctrine. These tariffs were not conventional. They were explicitly designed to penalize countries with which the U.S. ran persistent trade deficits. The new baseline was a 10% duty on most imports, but for nations the administration deemed unfair trading partners, tariffs spiked as high as 50%. The government formally justified this under the banner of restoring trade reciprocity, arguing that decades of liberal trade agreements had failed to protect American industry. According to the White House, many countries had externalized protectionist measures, while U.S. markets remained open. The logic, reciprocal tariffs would force a reckoning, correcting an imbalance in global trade that had become structural, but that was just the beginning. Within months, Congress passed the One Big Beautiful Bill Act, OBBB, a sweeping, more than 1,000-page reconciliation package that fused tax cuts, welfare reform, border security, energy policy, and debt policy into one gargantuan legislative instrument. The bill extended the 2017 tax cuts permanently, added new deductions for overtime pay, tips, and auto loans on U.S.-assembled cars, raised the standard deduction, and increased the child tax credit, among many other tax changes. Simultaneously, it cut mandatory spending, including massive reform to welfare programs such as Medicaid and SNAP, with stricter eligibility and work requirements. It also repealed many of the green energy tax credits introduced under past administrations. Perhaps most dramatically, the bill raised the U.S. debt ceiling by $5 trillion, giving the Treasury a fresh runway to borrow. The White House defended this as fiscally responsible despite critics arguing that tariff revenues combined with spending cuts would offset much of the cost. Administration figures projected trillions in tariff income and said that the bill would reduce or stabilize the debt-to-GDP ratio. It was, in their words, a once-in-a-generation opportunity to cut taxes, reform entitlement programs, unleash energy production, strengthen the border, all while securing a more sustainable fiscal trajectory. But the economic consequences of such bold policy are not abstract. They ripple outward into every corner of the American economy. The nonpartisan Congressional Budget Office, CBO, estimated that the One Big Beautiful Bill would significantly increase the deficit over the next decade. On a plain, conventional accounting basis, revenue losses from tax cuts alone could exceed $4 trillion between 2025 and 2034. That's before consideration of added interest costs on the newly ramped-up debt. Even on a dynamic basis, assuming economic growth from these policies, the CBO still forecasts a net increase in red ink. According to some reports, the final burden could reach $4.1 trillion over 10 years when rising borrowing costs are factored in. Economists further warn that tariffs, while generating revenue, also suppress economic output. Modeling from tax analysts suggests that high reciprocal tariffs could reduce U.S. GDP in the long run by nearly 0.8%, even as they raise revenue. Tariff income might ring the Treasury, but the cost to consumers can be steep. Import-intensive sectors see price hikes and consumer goods become more expensive. Tariffs, in effect, become a regressive tax, one paid disproportionately by those already feeling the pinch. The White House counters this projection with its own growth-based model. The Council of Economic Advisors, CEA, estimates that the OBBB could lift real GDP by 1.1 to 1.2% annually during its first 4 years. According to their analysis, job creation could balloon, take-home pay could grow by thousands for a typical family, and investment, especially in infrastructure and opportunity zone communities, would surge. The CEA further argues that spending reforms, combined with increased tariff revenue and growth, could generate offsetting deficit reduction on the order of trillions. Yet skepticism is widespread. Interest payments on the added debt could become a permanent drain. As borrowing costs rise, the government could find much of its daily operations anchored to interest obligations. That squeezes fiscal flexibility, crowding out space for discretionary programs, infrastructure spending, or even future social investments. In worst-case scenarios, future leaders may face either painful cuts or tax hikes simply to service past debts. For everyday Americans, working families, retirees, students, small business owners, these policy shifts translate into immediate, tangible consequences. Consider what happens when you go to buy a car. Under the OBBB, interest paid on auto loans for new cars assembled in America is deductible up to certain limits. That feels like a win. Lower effective cost of financing, and an incentive to choose domestically manufactured vehicles. But if those cars use imported parts, the tariffs might drive up their prices, undercutting the deduction's value. That tension captures the heart of this policy, intended benefits tangled with unintended costs. Take consumer electronics, clothing, or food, items often sourced globally. With the new reciprocal tariffs, many of these goods now face significantly larger duties. Supply chains strain, prices go up. What once cost $200 might now cost $220, $240 or more. For lower and middle-income households, those price increases matter. Every trip to the store demands harder trade-offs. Then there are social safety nets. The OBBB's overhaul of Medicaid introduces stricter eligibility requirements, demanding work or monthly hours from certain enrollees. SNAP recipients could face reduced benefits or more burdensome application processes. For a single parent or someone just above the poverty line, these changes may not be abstract budget cuts. They may mean skipping essential medical care, rationing food, or working more hours just to tread water. For many, the safety net phrase. Savings and investments also feel the shock. The bill introduces a new kind of Trump account, a children's savings vehicle with a $1,000 government seed investment. Families may welcome this, especially for long-term goals like education. But in a world of rising inflation and more volatile markets, that seed money alone might not offset broader financial pressures. Meanwhile, as the federal government borrows more aggressively, interest rates across the economy could rise, raising the cost of mortgages, credit cards, student loans. For a typical household, that could mean smaller savings, longer repayment periods, and shrinking discretionary budgets. Perhaps most fundamentally, uncertainty grows. The more aggressive the borrowing, the more sensitive the system becomes to shocks. If interest rates spike or economic growth slows, Americans may feel the pinch not just in their wallets, but in their financial confidence. And for younger generations, those building their careers, buying homes, or investing for the future, the risk isn't theoretical. It is deeply personal. At a higher level, the 2025 policy shift represents a deliberate remapping of the U.S. fiscal system. Previously, borrowing constraints, tax policies, and trade levers operated somewhat independently. Now they form a cohesive tripod. Generous tax cuts are underwritten by aggressive borrowing and tariff revenue. The government is effectively shifting its funding model. First, by dramatically boosting the debt ceiling, the administration granted itself long-term borrowing latitude. The Treasury now has a broader runway, but that freedom comes at a high financing cost. As debt rises, so do interest payments, threatening to dominate future budgets. That dynamic transforms the debt ceiling, no longer a short-term negotiation hazard, but a structural cornerstone. Second, tariffs are no longer just trade instruments, they are tax tools. The reciprocal tariff structure serves dual purposes. It penalizes countries perceived to exploit trade imbalances and raises revenue to fund domestic priorities. This duality blurs the lines between trade policy and fiscal policy. Tariff revenue, once modest and strategic, now serves as a significant part of the government's revenue mix. But that revenue comes with volatility. Consumer demand shifts, trade partners retaliate, and price elasticity can erode the expected returns. Third, welfare reform under the OBBB isn't just a tightening of benefits, it's an ideological reorientation. By imposing work requirements, increasing co-payments, and trimming eligibility, the government shifts the burden of social responsibility back toward individuals. The safety net becomes less automatic and more conditional. In political language, it's a reform. In human terms, it's a recalibration of who bears risk. Finally, the long-run risk of fiscal stress solidifies. As the debt grows and servicing costs rise, the government may face a crowding out problem. Fewer resources for discretionary priorities like infrastructure, education, or climate resilience. Every future policymaker may inherit not just the debt, but the obligation to pay it down, or risk default, inflation, or draconian cuts. In this way, the 2025 policy shift doesn't just change taxes, trade, or welfare. It re-engineers the feedback loop between government and citizens. It places more weight on the borrowed dollar, more discipline on the safety net, and more reliance on consumption as a revenue base. Whether that loop holds or unravels depends on economic performance, political will, and global response. To grasp the real human cost, we should meet people whose lives are already being touched by these changes. There is Marisol, a single mother of two, working 2 jobs. Her income hovers just above the threshold for food assistance. Under the new SNAP rules, her eligibility becomes less certain, reporting requirements tighten and co-payments loom. She tells her kids bedtime stories while silently calculating whether to use the last of the benefit card now or stretch it until next month. Then there is James, a veteran on a fixed income. He drives a modest car, relies on Medicaid for his prescriptions, and has little room for financial surprises. He welcomes the new auto loan interest deduction when his car eventually needs replacing. But now he fears that the price of parts and maintenance could rise, imported under the new tariff regime. His medication is already a stretch. If inflation spikes or interest rates climb, his monthly budget could snap. Lena and Michael are newlyweds in their late 20s. They opened a Trump account for their newborn, feeling optimistic about building a future together. They envision this money funding early education, maybe even a small business someday. But as the world shifts, so do their assumptions. If inflation continues to erode their earnings, that seed investment feels less like a foundation and more like a cushion, helpful but brittle. And then there is the broader society. Small-town manufacturers, previously marginalized by globalization, sense new opportunity. Yet global trade partners bristle. Retaliatory threats loom. Retaliation could hit farms, supply chains, and consumer goods. For workers in vulnerable sectors, this moment feels like a crossroads. Will we rebuild with renewed sovereignty or discover that raising barriers exacts a different kind of price? Even global players are watching. Countries hit by reciprocal tariffs must decide whether to retaliate, negotiate, or seek alternative markets. The tension pushes the world into a new geopolitical dance. Trade alliances reorient, supply chains transform, and power balances shift. For Americans, whether in Michigan or Mississippi, what once was a distant policy debate now resonates in paychecks and grocery aisles. The United States' bold tariff strategy did not occur in a vacuum. When the reciprocal tariffs came into force, key trading partners responded with a mix of defiance, negotiation, and caution. Some nations threatened retaliation. Others sought bilateral agreements to escape the harshest levies. The global trading system, already fragile, teetered on a new axis: reciprocal enforcement. For decades, the U.S. leveraged trade liberalization through multilateral institutions like the WTO. Now, in contrast, the administration leaned into a more transactional nation-by-nation approach. Economists warn that this transformation could undercut the rules-based trading order. If America openly weaponizes tariff policy to offset domestic tax cuts, other countries might follow suit. The ripple effects could include lower global growth, fractured alliances, and supply chain fragmentation. Nations dependent on U.S. markets may recalibrate while U.S. importers scramble for alternative sources, each shift reverberating through ports, factories, and shipping lanes. But the White House argues that this is not merely economic aggression, it is fiscal realism. By tying tariff revenue to tax reform, the administration believes it has built a more self-sustaining revenue model. In their framing, reliance on consumption taxes via tariffs reduces dependency on volatile income taxes. It's a financing model built not just on growth but resilience, though many critics see it as risk-laden, regressive, and vulnerable to escalation. In geopolitical terms, the U.S. gambit could yield both leverage and isolation. With higher tariffs, America gains more control over its trade relationships, but it also risks alienating longtime partners. The global order may not collapse overnight, but it may warp. Strategic alignments could shift, multinational companies may rethink investments, and emerging markets might seek alternatives to a U.S.-centric trade architecture. So where does this leave Americans, and where might we go next? Scenario 1. Fiscal reckoning. The most sobering possibility is that rising debt service costs become unmanageable. If interest rates continue to climb, whether due to global conditions or tighter monetary policy, the cost of servicing the $5 trillion of new debt could dominate the federal budget. Mandatory obligations like Social Security, Medicare, or defense might be squeezed. Without new revenue streams, future administrations may face either crippling cuts to social programs or tax hikes. The social compact could fray. Political polarization could intensify, as each dollar spent on interest is a dollar not spent on health, education, or infrastructure. Scenario 2, revenue normalization. Alternatively, tariff revenue and economic growth could play out as the administration hopes. If growth remains strong and trade partners adjust to new rates without sharp retaliation, the government may actually generate enough external revenue to stabilize deficits. In this scenario, the OBBB's tax cuts persist, but without the worst-case debt spiral. The U.S. could recalibrate by relying more on consumption-based revenue. That said, such a model is untested. Tariffs have historically been volatile, and using them as a long-term funding source carries political and economic risk. Scenario 3, reform and pushback. Civil society, state governments, and consumer groups may mobilize. If the social cost of program cuts becomes too steep, pressure may build to re-envision welfare policy. Progressive reformers could push for more equitable tax structures, higher rates on the ultra-wealthy, carbon pricing, or digital taxation. Trade partners could challenge the tariff regime in courts or multilateral foray. In this way, the policy could provoke pushback not just politically, but within the fabric of global economic governance. Scenario 4, crisis and reset. A more catastrophic path might emerge if financial markets turn. Suppose rising U.S. borrowing costs trigger a run on treasuries or investors demand higher risk premiums. In that moment, Washington could be forced into austerity, steep cuts, tax increases, or even renegotiation of debt terms. In a worst-case context, default risk or near default could precipitate a financial crisis. The trust at the heart of that floating dollar bill might fray dangerously. Each scenario carries consequences not only for economic growth, but for social cohesion, global relations, and the future of the American dream. Money is more than currency. It embodies belief. The 2025 policy shift was not just a legislative sprint, it was a redefinition of the social contract. By rewiring how the government raises revenue, leaning on tariffs, cutting social supports, and opening the debt tap, Washington reshaped its priorities. For some Americans, this looks like empowerment, tax relief, job creation, and investment. For many others, particularly those living paycheck to paycheck or relying on social safety nets, it feels like a reckoning. At bottom, this is a story about trust. Do we trust that the borrowed dollar will be used wisely? Do we trust the social commitments that once felt permanent? Do we trust each other, rich and poor, worker and investor, to hold up our side of the bargain? The 2025 fiscal architecture asks those questions with a force unlike any before. If your wallet feels lighter, if your groceries cost more, if you worry about what the future holds, you're not alone. The policies that define an era are often abstract until they land in our daily lives. For better or worse, this fiscal moment is not just about growth, it is about sustainability, it is about equity, it is about whether the architecture of power restores our faith or leaves us questioning what the American financial pact truly means.